Welcome. In this video, is Xcn coin bullish wave coming? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When we look at the chart in general, we see a very distinct and remarkable downtrend structure. This structure reveals that the price has been in a downward movement recently, making lower highs and lower lows. In technical analysis, such downtrends indicate that the overall perception of the market is negative and sellers are dominant. As the price moves downward with a certain slope, this trend line acts as a barrier that directs its movement, and as long as this barrier is not broken, bullish prospects remain technically weak. This falling trend line is usually a line that connects several peaks, and where upside attempts consistently end in failure. Such structures are both a point of resistance for traders and a reference point for understanding the strength of a trend. The current price action is also nearing this line. Therefore, price behavior in this area is quite critical. Because if the price manages to break this downtrend line to the upside, it could signal a significant shift in the market structure. Such a breakout would signal a weakening of the downtrend, a return of buyers, and a potential change in direction. However, the important thing here is not just that the price touches the trend line, but that it breaks it strongly to the upside. A true and reliable breakout usually occurs with a large and strong candle, supported by increasing volume. Such a move suggests to traders that the downtrend has ended and a new uptrend may begin. This creates trading opportunities in terms of technical analysis. In particular, a retest move after this breakout, that is a return to the trend line that the price broke, and an upward reaction from there can create a golden opportunity for traders who want to take a position. For this reason, the proximity of the price to this falling trend line should be monitored very carefully, because this line could be not only a resistance, but also a threshold for a trend reversal. If this line is breached, a very important transformation in the market structure may occur, and the price may start an upward rally after this breakout. In such a scenario, investors may first target near resistance levels, and then strategize on medium-term bullish scenarios. Especially if downtrends have been going on for some time, and the price is now close to this trend line, the price can move quite sharply with the breakout, as this usually creates a squeeze in the market. This is because when such critical trend lines are broken, technical traders, algorithms, and large funds can take positions based on this move. This increases both volume and volatility. While the first targets after a breakout are usually the previous highs, longer-term targets may come into play if these levels are also broken. It is very important for traders to follow this process carefully and analyze not only the breakout, but also post-breakout data such as candle closures, trading volume, momentum. This is because the market may experience false breakouts from time to time. In these cases, the price seems to rise above the line, but then quickly returns and can trap the trader. As a result, we have a very clear downtrend structure, and the price is very close to this trend line. An upside break of this line would not only mean the end of the current downtrend, but also the starting point of a new bullish wave. However, if the price fails to break this line and moves down again, then the trend should be considered to continue. Therefore, the actions to be taken at this critical level and the reaction of the price to this line will be one of the most important factors that will determine the direction of the market in the coming period, but we cannot decide the analysis only with trends. Let's look at other metrics. Keep watching. Analyzing the chart in detail, we see a classic and highly reliable Elliott wave structure. This structure is one of the most powerful tools used in technical analysis to understand market psychology and aims to predict trend direction and momentum by analyzing price movements through 5 main waves. Looking at the structure currently forming on the chart, we can see that the first impulsive move, the first wave, has been successfully completed, and the second wave of correction is about to end or has been completed. In this case, the next move is likely to be the third wave, which is generally known as one of the strongest and most severe bullish moves in market history. According to the Elliott wave theory, the third wave is usually the stage when the market has the momentum fully behind it. Buyers are in complete control, and many technical indicators are giving positive signals. This is the point at which investor psychology turns to confidence and a can't-miss feeling prevails. Technically, the length of this wave has to be at least 1/618 times the first wave. But this is only the minimum. In many cases, the third wave can be as long as 2/272 and sometimes even 2/618 times. This implies a very satisfying and potential bullish move for the price. On the current chart, the second wave correction seems to have shown a fairly healthy retracement according to Fibonacci levels. In particular, the 0,618 or 0,786 Fibonacci retracement levels are the most common retracement levels for the second wave, and the reaction from these areas could be the signal for the start of the third wave. According to this scenario, the bottom of the second wave starts to work as a support, and as long as the price does not break below these levels, the expectation of the third wave remains technically valid. Another issue to be considered at this point is the subwaves that will form within the third wave. Because according to Elliott theory, each main wave consists of 5 subwaves. Therefore, after the third wave starts, it is possible to see small-scale corrections within it. These mini-corrections should not mislead investors, as it is important to see the bigger picture, that is knowing that the third wave is still active in order to stay in position. On the other hand, this potential third wave movement could be a serious opportunity for investors. Because this wave is usually fast-moving, corrections are minimal, and the price can often break important resistances in one go. If the first wave was strong, and the second wave made a healthy retracement, the third wave will usually lead the market. At this point, Fibonacci extension levels can be used to set price targets. The most frequently followed levels are 1,618 to 272. These levels mark areas where the price could reach and bounce back or make a short-term correction, respectively. However, it is important to keep this in mind. For the technical structure of the third wave to work correctly, the general mood of the market should be positive. The news flow should support the price, and global factors should be supportive of buying. This is because the third wave is often a broad-based movement. Not only technical, but also fundamental factors should support this movement. Otherwise, the third wave may be shorter than expected, or there may be a horizontal limited upward movement instead of a strong wave. In conclusion, the second wave seems to be completed or nearing completion on the currently analyzed price chart, and if the price continues to stay above the current support level, the probability of the start of the third Elliott wave is quite strong. This wave could start with a minimum target of 1,618 and potentially continue up to 272 levels. Therefore, investors should closely monitor this movement, plan their positions correctly, and keep risk management in mind. Because third waves are the most satisfying and motivating periods, not only in terms of price, but also in terms of investor psychology. The RSI, or Relative Strength Index, is an important technical analysis tool that is frequently used by traders in the financial markets. This indicator is used to determine whether an asset is in overbought or oversold territory based on recent price movements. The value of the RSI ranges from 0 to 100, and generally, levels above 70 are considered overbought, while levels below 30 are considered oversold. However, it's not enough to interpret the RSI only within these limits. It generates much more meaningful and powerful signals when used in conjunction with trend lines, patterns, and especially certain resistance support zones. At the moment, there is a distinct downtrend that is noticeable on the RSI indicator. This bearish channel or trend line is a pattern drawn by connecting the RSI's previous peaks and trending downwards over time. Such falling RSI trends, regardless of price action, can be a sign that the market is losing momentum, that buyers are weakening, and that selling pressure is dominating. When each new high is formed lower than the previous one, this indicates that momentum is waning and the market is in a clear lack of strength. However, one of the most important things to look out for in such situations is whether the RSI can break this downtrend, because if the RSI breaks a downtrend to the upside, this could be a very important turn signal. Such a breakout on the RSI indicates that a gradually strengthening buying pressure has begun in the market, and momentum is starting to move upwards. This breakout is considered a trend reversal signal, which is often encountered in technical analysis. RSI indicators should be followed. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.